conditioner performed exceptionally well and earned an average rating of 4.3 stars from 5,000 plus organic ratings and 350 plus reviews in major e-commerce platforms. The Almond Drops Ultra Light Body Lotion for summer use along with the winter lotion saw an uplift in e-commerce channels on account of improved display images, new pack launches and campaigns. The Almond Drops soap witnessed consistent offtakes in modern trade chains and e-commerce channels with focus on various bundle packs offering taste on the retailer. The Almond Drops Hair Serum achieved 20% year-on-year growth in H1 FY25, aided by display and influencer support. Bajaj 100% pure coconut oil continues to deliver strong double-digit growth. We continue to witness consistent gain and nearing double-digit market shares in traditional Bajaj stronghold states. The market share in Maharashtra also saw an improvement in Q2FY25, supported by media initiatives and distribution drives. To enhance the brand market reach in general trade, specific SKUs of 300 ml jar and bottles were introduced during the quarter. We also launched the 1.2 liter jar for one major e-commerce platform. Digital marketing campaign across platforms delivered remarkable results, again achieving 35 million views and an impressive 1 million clicks. Pricing interventions were taken in Q1 as well as Q2 to offset the impact of inflation in copra prices. As of now, we have taken 6% in our Bajaj 100% pure coconut, and we'll continue to monitor the copra prices to see how much further pricing will need to be taken. During the quarter, we relaunched Bajaj Gold 100% pure coconut oil with improved packaging and formulation for the east and northeast markets. The product is now available in 3 SKUs of 100 ml, 200 ml bottles and 175 ml tin. The GTM targets for both primary and secondary were exceeded. The initial product feedback on this brand has been very encouraging from both the channel partners as well as consumers. With the launch of this offering, we expect to gain market share in coconut oil category in the eastern states. We continue to make good progress in diversifying our portfolio, with the NPD and traditional portfolio now contributing 20% with a double-digit growth in H1 FY20. On a 3-year CAGR basis, this portfolio has been in excess of. This highlights that our strategic pillar of portfolio diversification. During the quarter, the LLP prices saw a marginal decline due to weak demand and reduction in crude oil prices. Refined mustard oil prices strengthened by about 11% year-on-year, driven by higher import duties on all edible oils and limited mustard availability. The copra prices also saw substantial increase year-on-year as well as sequentially, fueled by higher demand. Both the latter had an adverse impact on gross margin for the quarter. Multiple initiatives have been taken to reduce material costs structurally, which will give us sustained benefits for the long term. These initiatives have resulted in savings of over 2.5 crores in the first half of the current financial year. Our focus on increasing productivity through smart manufacturing programs and use of technology have resulted in improvement in productivity by 6% at our Guwahati facility and 14% at our Paonta Sahib facility in this year. We remain committed to ESG goals by optimizing processes to reduce water consumption and energy consumption at both plants and pursuing water positivity in line with the ESG targets. The key initiatives to lower carbon emission include automation and installing advanced machines, energy-efficient compressors, and Miyawaki tree plantation project at our plants. We implement rainwater harvesting projects at our plants, which led us to being about 5 times water positive. CSR initiatives through rainwater harvesting and sustainable agriculture practices undertaken during H1 has positively impacted more than 11,000 families across 420 villages, mainly in UP, Rajasthan, and Maharashtra. To sum up with rural growth continuing to be resilient, sluggish demand in urban expected to have bottomed out, we expect demand conditions to improve going forward. This, coupled with our thrust on our strategic initiatives, expanding the distribution reach to Project Aarohan in general trade, portfolio diversification, cleaning of organized trade, scaling up of international business, we are confident that our performance will track well and achieve sustainable growth in the near to the medium term. So with this, I end the opening remarks. and open the.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Our first question is from line of Avnish Roy from Nuvama Wealth Management. Please go ahead.
So thanks. My first question is on the geo-tagging and fencing. What exact benefits will come in the urban areas once in November all the outlets will be covered? And how common is this with the larger hair oil companies? So will it be more that you come at a level playing field with them in the urban areas, or this is something different versus the larger players?
No, so absolutely correct, Avnish. We'll actually come level playing with most of the larger players. I would not say all the larger players, but most of the good practiced FMCG companies all have done geotagging, and fencing is one step higher. So I just explained. So geotagging is basically you go to each of these retail outlets and basically tag the outlet so that you know exactly the longitude, latitude of that place. So first and foremost that you figure out is that what you are reporting in your system, in your both DMS as well as SFA, etc., are actually shops which actually exist. And in this, there will always be a little bit of a churn. You will actually find that there are phantom outlets. This has happened for all companies. We are also seeing there are some, not very large numbers, but in certain places physically that actually physical shops are not there. So what happens is, as a result, your efficiencies, moment you identify the shops and actually tag the shop with a specific location, then even when your ISRs, etc., are visiting, then if you are reporting 40 outlets, they'll actually have to visit 40 outlets rather than have some 10 outlets which are phantom outlets, which actually you just visit 30, but actually you are reporting 40. So this efficiency will come in. Fencing is one step forward where after you have tagged the outlet, you actually fence it, whereby you can only take the order from that shop when you have reached that shop. You can't take an order for a shop, let's say, 2 kilometers away. So then it's absolutely perfect. So fencing is a little more hard-coded. So we are trying out with a few states to see how it will work. We will not go ahead with all the states also at the state. But tagging is something that we want to do so that we have an absolutely clean retail map as far as entire urban this thing in the country is concerned. So we have finished about 80%. We will be, we are now near completion. So we have a full map of where our outlets are. And now when you add, you will actually be also tagging them as we add them. Earlier this was not happening. So this has been done in the last maybe a couple of years by some of the top players. So we are just going to do that as well and be at level playing field with the top players. Many of the large players, they do not have that.
So to understand this better, ultimately when this is fully done and there is some time for execution, this helps revenue, does this help cost, or does this help in terms of better selling of new product, because sales guy will have to go physically to the store, because the phantom store which you explained, it seemed that virtually things are being managed, so actual effort may or may not be there. So could you tell us revenue this will help, or in terms of cost this will help?
So it will help both. So if you look at, cost to sales will clearly improve. It will become better because while you are reporting that you are going to 40 outlets, you are actually going to only 30. So now you will have to go to 40 new outlets. The moment you go to these 40 new outlets, because if that is your, let's say, effective mandate, you need to visit 40, then you will have to identify those new 10 outlets and go to those shops. So two things will happen. Either you will reduce the number of people by looking at the geography if such outlets don't exist, but typically that does not happen. Typically what will happen is those 30 that the fellow was doing in the beat, he will have to add 10 more and do that covering. So it will be a mix of both. There will be some maybe pruning of one or two ISR territories, etc. But most of them will actually have to physically add these outlets there to ensure that this effective mandate is covered. So it will both help in cost to sales as well as in terms of number of outlets that you add.
My second and last question will be on the pure coconut oil business. You have done good scale up in those 4 states where you have called out. So if you could tell us, one, there is a very sharp inflation in copra. So have you also passed on to the end customer similar to what market leader has? Second, for example, this 2.1% market share in Maharashtra in coconut oil. Where has this come from? Is there repeat purchase happening? I'm sure you are offering more value to customer versus the market leader, which is fair because you have entered late. But is the repeat purchase also happening, and how is the market leader retaliating? Because they are extremely large. They have much better sourcing advantage than you, because it's not possible for you to have the same sourcing advantage. There is no comparison in terms of size. So if you could also talk on profits, how are profits in this business in terms of gross margin?
I'll start with the second last premise of yours, which is what I've been countering for quite some time, and I personally think that is a great work done by our supply chain team, whereby if we track, because for copra price, because it's a single commodity price, we have a good understanding of who's buying at what price. Unfortunately, because of our strong backend, we have been tracking for the last 8-9 quarters as to what kind of prices, let's say, everybody is buying versus us. And in quite a few cases, we have actually had a better pricing. It might be a little difficult to understand why in a player which is much larger can be think, because some of it is also based on your forward purchases, etc. Because some of them will have to be speculative purchasing in terms of a little bit of advance too. So it can work both ways. If you purchase in advance, if the prices were to fall, somebody else will get an advantage. But fortunately for us, the last 8-9 quarters, we have been able to at least track it well. Our market intelligence have been pretty strong because we have invested a lot of effort in terms of getting our entire backend right up to the copra farming, to the farmers, etc. So good understanding, right from me downward to a lot of people have a very deep understanding of how this entire cycle works, and we have a sense of where the price is going, what is NAFED doing, what is in terms of NAFED doing, what is in terms of the Kerala Farmers Union doing in terms of pricing. So we keep a good track of that. So fortunately for us, we have been able to do pretty well in terms of purchase pricing is concerned. There's not too much difference between what we purchase, but it might be a little difficult to accept it from the outside, but that's how what the truth is. The other thing that we had done is, we had also price indexation wise, we had started with about a 10% lower MRP as far as the larger player is concerned, because that's how we wanted to do it. Now, if you look at the pricing now, the price gap, and that is something that we have consciously said that if we actually scale up our product and we are able to cross the, let's say, the 3-figure mark and go beyond, let's say, annualized basis, and which we have done earlier itself. So that we will slowly bridge the gap. Today, that 90% is slowly moved towards 95, and we tend to take this even further. Basically, the price indexation for that. So we intend to take some advantage from that. And the third thing that we talked about is in terms of pricing, passing on the price. I think from the market that we get, in fact, one of the good things that I would want to report, which I reported even last quarter, is that general trade today is higher than modern trade plus e-commerce as far as coconut is concerned. I think that is a great proof of that the product has got well established in the marketplace, and even in Maharashtra, etc. I'll come back to the Maharashtra question. So having done that, now we are clearly seeing that we are able to pass on the price narrative. As I said, we have taken about a 6% price increase as far as Q2 is concerned, and we look to even take further price increases in Q3 as we work on. So this is the price gap that we'll be maintaining. As far as Maharashtra is concerned, it is not first time seeding, etc., because the product was launched in Maharashtra about 7 quarters back. So this is more repeat purchase we are having. So distribution is going up in overall country level itself. We have more than 50% our distribution is already coconut. Of ADHO. What we have in ADHO, more than 50% of that is already. So that's a substantial number, I would like to think, as far as the new product is concerned. So it is tracking well all across, and I think we are in a position that we can make our coconut portfolio far stronger off. Yes. Thank you.
So thanks. That's all from my side. Thank you.
Thank you. Our next question is from line of Ansham Nandeja from Bryanston Investments. Please go ahead.
Yeah. Hi, Jaideep. Good afternoon. A very basic question, which I think most of the people would have, and I really appreciate some of the things that you guys have been doing over a period of time. But if I just look back 5 years, and see ultimately whatever you are doing is towards the betterment in terms of both revenue and bottom line. So 5 years back, we were at around 900 crores top line, 250 odd crores operating profits. And after all the changes that we have been doing, some successful, not so successful, we are still at the similar level of top line and half the amount of bottom line. So as an investor, how should we look at it now, and when will the numbers come, and when will the company grow?
It's a perfect, absolutely perfect question. And I think if you look back 5 years back itself, we had said that this will be a hard uphill climb, because a lot of the things, initiatives that we are talking about, some of the things that you said are good, are tracking well and good initiatives taken. We knew that all of them will be investment hungry. There was no easier way out, because ADHO had done great work, and ADHO obviously needed to grow, but the market needed to grow along with for ADHO to fuel its own growth. But we wanted to ensure that all the other levers that are required to be pushed are pushed, because otherwise it would always be a situation where we will keep looking for a higher EBITDA in the short term and not compromising the mid to long term perspective. And that's why we looked at our modern trade e-commerce, which if you remember 5 years back, e-commerce was 0.5%. Yes, COVID did help, but the kind of numbers we are reporting is I think best in class in terms of the percentages that we are using. The organized trade business is now at 30% salience, which I think will remain at one of the best ones, given that there has been pressure in GDP. So this is one. Two is, we were to look at what beyond ADHO. ADHO 5 years back, as you said, was a 5% contribution. Today, that contribution, or rather the non-ADHO, the product range beyond ADHO was just 5%. Today, that has come to 20%, and as you can see, all of those ranges, whether be it AD extensions, that is hair and care, hair and skin range, or whether be it the coconut range, all of them have been expanding much better. Where ADHO remains where it is in terms of the market. If the market is declining, ADHO is also falling track. Yes, I would agree that there have been not sharp gains as far as ADHO is concerned. That could have only happened if you had gone into, let's say, the southern markets or some markets where we are underrepresented. So that I would admit has not happened. So all the tracking that we were planning to do, all the initiatives that we are planning to do, international growth, modern trade, etc., I told you, products, etc., all of that tracking. So the big difference that we had done during our projections at that time as today is that we did not expect the market to tank this badly, and especially in the last 2 years, the way we have been saying, we had not projected that. But I think the fundamentals, or rather the basic structure, the foundations of the company doing well have been all put in place, whether be it systems, processes, people. These are all things which are never mentioned, but I think the kind of people, quality, etc., that we have built, I think we can now very clearly set for a growth. The market obviously needs to turn, and when the market turns, we are in a comfortable growth.
So two, three things quickly here, Jaideep, and just a follow-up of these questions. First, if I look at ADHO as a portfolio, if I look at last 5 years, probably the RM prices have gone up. So I'm sure our average product prices would have gone up there. And ADHO falling as a percentage of sales would mean that others should be able to aid the sales rather than absolute sales remaining at the same level. So while we would have got probably 150 crores or 200 crores from new products, I'm sure your thought process would also have been that this will add to the top line. Unfortunately, that has not happened. That's the first part. Second, we've always maintained in the past that EBITDA margins would suffer, but company would maintain absolute level of EBITDA. In this case, the absolute level of EBITDA is actually halved. And this is also happening in the backdrop. When you look at last 5 years, most of the consumer companies have actually grown their top line by 50% on an absolute basis over a period of 5 years.
Yep.
So I think when I look at this and when I look at our performance, is it something that we need to actually rethink as to where are we going? Are we actually undermining ADHO? Is it actually something which we should be focusing on because that leads to larger growth?
So as far as ADHO is concerned, so let's answer all your questions in part. So as far as ADHO is concerned, if you look at all the levers that could have been pushed are being pushed. So whether be it looking at the entire digital aspect of it, bringing the entire digital, earlier we did not have anything working as far as digital part is concerned. We created the digital marketing team, etc., and a lot of good work as far as the digital side of it has already happened. In terms of marketing campaigns, a lot of the thematics, etc., has been changed, made it more topical and more relevant to the new age customers. So that work itself has happened. As far as the product is concerned, in terms of new issue additions, newer packs, newer SKUs, in terms of initiative as far as the packs, etc., themselves are concerned, a lot of it has already been in place. But yes, the market is what it is. In spite of pushing the almond drops, it has had its impact. Yes, I would agree on that. Now, coming to the point that you said that all the other companies have had this growth and we have not, you are absolutely right. But on the same point, you also need to look at also how much has been contributed by new products or from portfolios which they already had. Unfortunately, our portfolio is only ADHO and nothing else. All the other companies had portfolio. Whether all these competitors that you talk of, they have been able to play one portfolio or the other which they have been able to push up. If you look at, you dissect this growth in the last 5 years, obviously there will be some companies where only new products have achieved that. But most of the other companies have been from portfolios either of acquisitions they had done earlier, which have now started scaling up, or portfolios they already had, which have been clear. Unfortunately, we did not have that advantage, and that is what we are setting up for. The only other choice that we would have had is, do not take up this new portfolio, do not take up the international wages, just push on ADHO. I am sure ADHO might have given another 2% growth over and above. I am assuming, I am not so sure. But in case that, I would think the company would have reported better EBITDA margins, but would have been structurally much weaker, which I think is something that we would have wanted to avoid. I think we are in for a much better future than we are today.
So last question then, Jaideep. Does this mean in next 5 years?
I request you to join the question queue for any follow-up questions.
Just a follow-up to this.
Okay.
So Jaideep, in the next 5 years.
Thank you. Our next question is from line of Gaurav Gandhi from Glorytail Capital Management. Please go ahead.
Yes, thanks for the opportunity. So, sir, as of now in the market, the way this quick commerce is growing in metros, have we looked at our arrangements with these quick commerce companies about showcasing our products, and how are we looking at improving our sales from these quick commerce platforms, and about the display of our products? So, because it is really very important to grow our top line and get our products on the customer preferences. So, your thoughts on that?
So if you ask me, that is one area where I would think that we have not done as well as we would have liked. Even in the last conference, I mentioned that quick commerce has to become one of our key focus area, and we have to just go upside down to ensure that quick commerce, we have growth which is far higher than what we are. We had a 42% growth as far as quick commerce is concerned this quarter. I think that is, if you ask me overall, where my disappointment would be in terms of initiatives, this is one area where we have not done, and clearly that's the focus area. I am sure that in the quarters going forward, that you will see far better performance. 42% is good, but not good enough. I think it should be in triple digits, this growth rates, and that is what we are targeting. Clearly, the team as well as the entire marketing as well as the sales team in terms of how the assortment should be, how we should be placing it, how we should tie up with all the key players, etc. I think that clarity is already there. We just need to ensure that execution, which work has already started, will happen, and we become a far stronger player as far as quick commerce is concerned. Clear. I don't think there is any dispute in that, and you have absolutely identified the issue right on actually. Yeah.
Right. And the second question is, now despite every quarter growing revenue from new products, we are unable to grow the absolute revenue number, and it's still stable at where it is. So can we come out with the assumption that there is some permanent loss of revenue in almond hair oil category? I mean, because, your thoughts on this?
No, you will not be able to come with that theory, because see, if you look at, just look at the current situation today. You look at most of the consumer companies reporting what they are reporting, and just look at just sheer numbers. If you look at food inflation in April was 8.7, May 8.7, June 9.4, then it dipped a bit in July, August. It's back to 9.2. With this kind of food inflation that is happening and the real wage going at best at 4 to 5%, you expect discretionaries to take a hit. Staples will still do a little better. Discretionaries will take a hit. Now the question is much broader. Do we trust the Indian economy and do we expect the economy to do well? And if that does well, then this will have to come back, or do we not? It's a more fundamental question rather than a Bajaj consumer question. If we trust that yes, the economy will do well, this is more a temporary phase, maybe a 2 quarter, 3 quarter, 4 quarter phase, and it has to turn. If that is the case, then obviously it will come back. I don't think Almond Drops has lost any specific share across. Our shares remain more or less steady at similar levels. So that will happen. But yes,
that's right, sir. But looking at the choices in the market में इतनी choices है, तो ये एक्सेप्ट करना सही रहेगा कि ठीक है, आलमंड हेयर ऑयल अभी इतना कंज्यूमर प्रेफरेंस में नहीं रहा जितना पहले था. So accepting is better, or should we keep on expecting that there will be growth in the revenue from that category?
I would think it will be the latter, mainly based on when the market. So as I said, almond ka acceptance घट गया etc. is not something that I will subscribe to. Yes, the market has gone down, and you see all the major players have this thing. Even the other very, very large player other than coconut, the other large player also has had the similar thing. I don't think there is anything happening to their brand equity as well. This is just that the market is now under stress, so the cheaper products are selling, etc. When the market comes back, all of this will see again a natural growth back. There has been no overall shift in the marketplace where the practices itself have changed. Hair oil usage has gone down. We track the Kantar data, look at household panel data. We don't see significant drops, etc. happening either in terms of hair oil usage or the frequency of use, etc., etc. So I think we remain quite balanced. Yes, the market conditions have been difficult. As the demand conditions turn, I think we would also bounce back.
Okay, sir. Fair enough. I appreciate your efforts. Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your questions to 2 per participant. For any follow-up questions, you may rejoin the queue. Our next question is from line of Shirish Pardeshi from Strandom Broking. Please go ahead.
Hi Jaideep and team, good afternoon. Just 2 questions in the beginning. You said that non-ADHO portion is now 20%. Correct?
Yeah.
So my question is pertaining to the overall hair oil business for us. So if you include coconut, almond, and all the hair oils put together, what is the volume contribution of non-almond almond oil in terms of volume?
Non-almond oil. See, as I said, overall is at 20%, and Almond Drops hair and skin range also is a substantial portion. So we will keep it at that. I would not be able to split you exactly the hair oil versus the non-oil numbers. But this is where we are. 20% comes out of that, where coconut is a substantial number, Amla is another number, as well as the Almond Drops hair and skin. These are the 3 main contributors, with others contributing here and there. So that gives.
I understand. I'm trying to find out the margin depletion story. If the almond drop price premium to coconut, and if the coconut portion is going to be stronger in terms of volume, how this margin story is going to pan out in next 3 to 4 quarters? Because what you said that now you are 2.5 share in Maharashtra, and Maharashtra being a coconut oil market, if that volumes comes in, what are the levers which are available? I mean, yes, cost efficiencies and other thing which is ongoing.
So correct point. So if you look at both Amla and coconut, both of these portfolio, which are the larger of the portfolios, and the Almond Drops hair. Almond Drops and hair and skincare range, obviously the gross margins are similar to ADHO. So there we don't have an issue. The Amla and coconut obviously are lower than the Almond Drops too. Now our expectation is the market improves, then Almond Drops itself will perform better. Almond Drops has not done well, so this margin looks depleted. The moment Almond Drops were to come back, we'll be seeing gross margin dilution of going up.
Okay. My second and last question on the net distribution or STR, if you have the number, if you can share, give me a little more depth in those 4 states where we have taken action on coconut. So what is our ND for almond drop and coconut?
See, our ND is typically, as you are aware, about 8.5 lakhs is as far as our 8.6 now as far as ADHO is concerned, and as far as coconut is concerned, it's already reached about 3.8 or close to that number. So it's already
3.8 lakhs.
8 lakhs, yeah, 3.8 and. Yeah.
And specifically in Maharashtra would be much higher?
No, it is all across. So Maharashtra is also tracking well, but I think the numbers are still a little higher on the northern side. So all your states of UP, Rajasthan, MP, Punjab, Delhi also to an extent, Haryana to an extent. Yeah.
Okay. Thank you and all the best.
Thank you, sir.
Thank you. Before we take our next question, we would like to remind participants that you may press star and 1 to ask a question. Our next question is from line of Kaushik Poddar from KB Capital Markets Private Limited. Please go ahead.
Yeah, last time you have given indication that the turnover will be growing at the rate of around 10% or something for the next 3 to 5 years. So, in the light of whatever consumer slowdown, rural slowdown, do you modify that forecast?
Yeah, I think if you look at the midterm, I would not like to modify the forecast because I think now that both rural slowly coming back, urban now bottoming out, we don't feel that it will continue to bottom out and there is a bottomless pit. So we don't think so. Yes, in the near term there might be a bit of a pressure, but I don't think in the midterm also, in fact, a little more than the near term and midterm, I don't see any pressure. Most of the things that we have now put in place should track well, so we should be back on good growth. So I am not going to revise the midterm numbers as far as.
Okay. Now, on the non-ADHO portfolio, is it something that you are trying to emphasize more than others? I mean, is this any product or any category that you feel has a higher growth potential than others?
A good question. Two portfolios clearly. One is obviously the almond drop hair and skin range. I think we have been seeing good traction at shampoo, at conditioner. Conditioner is very small. The summer lotion that we launched, we got good traction. Now the winter lotion loading is happening. Last year we got some good responses from the winter lotion. We launched the hair serum sachets in West Bengal, which is the sachet market. In serum we are seeing good traction as far as modern trade and commerce is concerned. We are looking at serum going across the country in general trade as well. So overall almond drops extension portfolio or hair and skin range, if you may, we expect that has a good future. It will take, it's already showing good traction to become substantial and start contributing big time to the revenue and profit. It might take another 2-3 years, but I think clearly that traction has been seen. Last year, this time I may not have been so confident, but today I can confidently say that we are seeing good traction in those products, those 6-7 products that we have launched, and we will continue to push that. We have also seen good traction coming out of our coconut, and as I said, all the measures that have been taken to ensure that the profitability of coconut, obviously it will not track as well as the almond drop profile, but as much as it can, which is still better than all the other hair oils put together. Clearly, we are focusing on everything that is possible to be done as far as coconut is concerned. So whether be it the green coconut that we have launched in the eastern markets, whether be it the blue coconut which has been launched in all the other parts of the country, some of the other products which we are planning to launch maybe in the coming quarters, etc. We feel that the coconut portfolio will be a large portfolio as Bajaj is concerned. That inherent strength of the confidence of the Bajaj household name and the quality that we provide has stood us in good state, and that is something that we do. So these two ranges clearly. There are certain other ranges that we have already in pipeline, but we don't want to launch it now because there are already so much in the portfolio in the pipeline. Until the market conditions improve, we would not like to look at a phase 2 of the launches in some of the other products, but that is something also in the pipeline. So as far as pipelining is concerned, we are very clear at this stage. Almond drops, hair care range, and coconut range, and not coconut oil only, but the coconut range. These are the two things we will push quite strongly, and we look at future as the market conditions.
Coconut range means what? I mean, beyond coconut oil also?
So beyond pure coconut oil. Yeah. So today we have two pure coconut oils. One is as far as the rest of the market is concerned, which is a pure coconut copra grade 1 oil, and the one that sells in the eastern part, which is similar to the market leader, which is Shalimar, which is also a pure coconut oil, but that's not grade 1. It has a roasted smell. It is a little different. You can distinctly different texture and feel. So that is what we have. These are the two products. We feel that there are two more other products that can be launched in that. So work is already there. Good gross margin profiles. They will also come back. Yeah. One you can obviously understand is the value-added coconut, which we already had a cocoa onion. That needs to come back. We'll have to see when we time that launch, as well as another one we are looking at in that range. So there will be about 3-4 products in the overall coconut portfolio. Yeah.
Okay. My last question, which is that, I think the eastern region.
I request you to get back to the question.
Let him finish because I think there's a question.
Sure, sir. Yeah.
Yeah. Yes.
Okay. My question is, I stay in the eastern region. I don't see much of advertising or sales promotion in this thing. I mean, is it done at the shop level or something that I'm missing out, at least on the newspapers or magazines or anything? I don't see much. I mean, how is the ASP tackled in, say, eastern region?
So what we wanted to do, and that is what is the template that we have put for most of our new products is, first we get into a GTM. Once the entire GTM is over and it has already reached the retail outlet sector, which is typically 40 days to a 3-day process, then we get into both, either in complete local advertising or definitely POSP. POSP, I mean, you have already seen POP and POS already at the shops with various green T-shirts and danglers, etc. Those are already there. Already we have had a digital content made specifically for the regional language in West Bengal. So that is already there. Some of it is already there. You may not have tracked it directly. We are now exploring whether we need to get into regional language advertising, etc., like we have done in Maharashtra and some other parts. That is something we'll have to decide based on how we want to push the range. So yeah.
Okay. Thank you. So the 10% medium-term growth stands, right?
Yeah, definitely. We would like to.
Okay. Thanks.
Thank you. Our next question is from line of Percy Panthaki from IIFL Securities. Please go ahead.
Hi, sir. So our overall EBITDA margin is around 15%, but it's a story of two parts, right? ADHO is quite profitable. Some of the new businesses or rather new products would be either very low margin or might be loss-making. So could you give us some idea as to what these two parts are? So like if ADHO alone, if I look at, can I say that it's like 20% plus margin and then there is a certain loss on the remaining products? Can you give some idea on that?
It's perfectly correct. It's not loss-making for all the products, obviously. So yeah, some of the products we are investing in, let's say most of the AD extension products, the EBITDA margins will not be positive. Some of them will not be positive at this stage. Yeah, but the gross margins are in upwards of 55%. So we are investing in some of these products. Some of the products like coconut, etc., they are positive as far as EBITDA is concerned, but not obviously in the range. So if you look at very, very overall, if I were to give you a sense, then yes, ADHO remains 20% plus, and the difference delta between ADHO and the non-ADHO would be roughly about a 6% difference between an ADHO and a non-ADHO.
Right. Secondly, I just wanted to understand on ADHO, if I look at the sales versus pre-COVID, I think it would be flat to a marginal decline. And over a 5-6 year period, the pricing has gone up close to 15%. So would I be right in estimating that versus pre-COVID levels, the volumes of ADHO are down about 15%?
No, I don't think so. So if you look at the volume, the value sales, if I look at the 4-year CAGR is about 4% from 817. Give me a minute. That's the overall thing. Is about 780 to about 792. So that's about a 0.5% this thing. And in terms of price increases, I think the overall price increases will be in the 7 to 8% range. So yes, there has been a little bit of a drop, but not to the extent that you are talking.
Okay, understood. And can you give us some idea as to, again, on the margins, what is your plan? One is on ADHO. Do you expect to keep the current margins?
Sorry, give me 1 minute. I just took out the data. So the volume decline in a 4-year CAGR as far as ADHO is concerned is minus 0.6%. Minus 0.6% is the volume decline in ADHO, and the value growth is 0.4%. And
this is over what period, sir?
This is over a 4-year period. So
okay.
So 4-year period, 22-24. The difference, I'll just explain the difference in terms of the price increase, etc. So one of the things that also has happened.
So 20 would not be a correct starting point, because FY19 your sales was 880 crore, FY21 also was 898 crore, but FY20 because of the Q4 destocking last 15 days, it was only 820 crore. So I think FY20 is a very low base to start off with. If you could either look at FY19 or 21, it would be okay.
Fair enough. So what I was trying to explain. So look at FY21. If I take
okay.
FY21, the CAGR is minus 1.3% and minus 2.7% respectively, value and volume. So what I was trying to explain to you is that the price increase, part of it, what you have said is correct. But the way you would have seen also tracking is that a lot of larger SKUs have been launched. The 475, the 650 ml we launched, the 700 ml we launched. That price per ml is a little worse off as far as this is concerned, which will happen for a very, very large pack. The price will be better offering to the consumer. So that has also offset where the volume growth has happened, but the value growth has not compensated for that. So that's why, in spite of the price increase, the difference is of just about 1.6% between value growth and volume growth. Volume being 1.6%, CAGR was lesser, 3-year period.
Understood. And sir, how do we look at EBITDA margins going forward?
So I think that, as I said, we have been maintaining. So as of now, it's at 15.5. We are doing a project as far as the strategy part is concerned. The strategy project, which is taking about 0.5 to 0.6%, roughly about 0.6% from our EBITDA. So it remains about 16-ish%. So this will go through some bit of curve at this stage itself. But I think overall, that 16 to 18%, which remains standard, I think remains very, very. Is what we.
But in the near term, have we bottomed out, or in the near term it can go even lower?
It's very difficult to project. It will be a function of what happens to the RM prices, where we take pricing action, how competitive action is, how demand. So it's a very difficult comment to make at this. But this is what 16 to 18 remains our target, and that's what we are tracking.
Okay, sir. Thank you very much.
Thank you.
Thank you. Our next question is from line of Amit Purohit from Elara Capital. Please go ahead.
Yes, sir. Thank you for the opportunity. So just on the quick commerce side, you said that you were not satisfied. One, I wanted to understand the arrangement that you have with quick commerce guys, and what are the kind of brands that are getting sold in quick commerce and getting good acceptance for it.
So, sir, as far as quick commerce is concerned, in fact, other than Amla, basically we are saying the entire range. So ADHO, we are continuously looking at improving our assortment, all the SKUs getting listed with all our partners. That is obviously one. Ensuring that our availability is across all the regions. That is other thing. In fact, we are at this moment Blinkit. We are directly billing. Well, Zepto is going through our distributors. But in terms of the product range we are pushing is obviously ADHO, entire range across all our partners, as well as across the entire region, all the regions, as well as the coconut is doing well on that as well. So we want to take it much higher than what we are doing, as well as the AD extension range, the shampoos, the lotions, the serums as well. So that is something that we are also pushing.
And what would be the salience of quick commerce right now?
So quick commerce salience, as I said, is low at this stage, only at 6%, which we think can really scale up much stronger. Yeah.
Okay. And just the last thing on the extensions of ADHO, is the acceptance on quick commerce relatively higher, or it is too small to now talk about it?
So wherever we are seeing responses, the responses are very, very encouraging. So that's where we are going very heavy on the AD extensions as far as quick commerce. So quick commerce, obviously, as you are aware, the margins at this stage, at least as of today as we speak, are better than the larger e-commerce players. So that also obviously is an incentive for everybody as well as us. And fortunately, we have seen good traction as far as our AD extension, hair and skin range products are concerned, which is what we scale up significantly further going forward. At least we are able to do.
And last on the channel mix itself, you highlighted that almost, I think, 30% of the sales comes from the organized retail, right? So is this share likely to go up? Then is there any impact on our overall margins profile for the company?
So I think at 30%, we are already topping it out. I don't think there will be a significant increase because our major focus is to ensure the general trade, which has had not a muted performance, come back strongly. That is what will be the effort in. Yes, the 30% can go up a few percentage points here and there, but I think roughly topped out as far as that is concerned. The 70-30 mix is what will be the new normal as far as what we think is.
And why do you say that quick commerce will have better margins than e-commerce?
See, it's just a power of negotiation as far as the two very, very large players are concerned. If you look at the two large players, I mean, given the fact that they also see that that general trade, most of these companies are finding it difficult to scale up general trade. They also realize that we are the easy growth drivers, growth levers for most of the companies. So they also extract their pound of flesh. Maybe not in the last 1 quarter or so, as they see the quick commerce scaling up, and they have to also. But other than that, both these two large players have been commanding their